Check, check. How are we doing? Can we hear? Great. All right, I got 3 killer panelists with me today. We're going to do the typical macro Bitcoin talk, but we're going to kind of give it a little twist. We're going to talk about some capital controls and how to think about the coming decade. So I know most people here know you guys, but if you want to give a quick blurb on who you are for those that don't know.
Yeah, Mark Moss.
I'm Dylan, by the way.
This is Dylan, of course. Everyone knows Dylan, the wonder kid over here. Yeah, I'm Mark Moss. I make a lot of content about Bitcoin, looking at mostly macro geopolitical pictures as to why. Why do we want Bitcoin? What activates that? What problem does it solve, etc. You can find me on YouTube or on other podcasts, just Mark Moss.
Alden. I try to do some investment research, put it out there, and I also work with Bitcoin startups to varying degrees to bring capital into the ecosystem and help build stuff out where I can.
Preston Pysh was a value investor. Figured out that if you're going to do the math, you're going to have to figure out what Bitcoin is. And now I create content around Bitcoin and also a part of Ego Death Capital. So great to be here.
Love it. All right. So all 3 of you guys, including a bit of myself, have commentated on the state of this kind of debt cycle, where we are, and I think that's led us to Bitcoin in a way. But just to preface this convo, we got 30 minutes, so we're going to make it quick. But where are we in the state of the monetary system? Why are we so concerned with these debt figures? And Lynn, especially, you've drawn some great historical analogies of this kind of macro cycle and where we are. Like, maybe just give the audience a little bit of background about what we're facing today here in 2023.
Sure. I think different things obviously bring people to Bitcoin from different angles. Some people get brought in from the tech route, some people get brought elsewhere, and I think a lot of, in our case, we were brought in by stuff we're watching in the debt markets and the currency markets. That was like a big lens for a lot of us. And so for the past 40 plus years, we've been in this environment of steadily declining interest rates, higher and higher equity valuations, more and more debt as a percentage of GDP, and that's been kind of this like nice coasting scenario. But as we enter this next period where we have maybe sideways interest rates, asset prices that therefore are maybe struggling to go up, deficits that are completely blowing out for demographics reasons, as well as the fact that 40-year machine is kind of like out of juice now, we enter, I think, a more challenging time. And the analogy that I've often been drawing from, there's no perfect historical analog, but when I look back at the 1940s, it's the last time public debt as a percentage of GDP was this high. I look at it from both the UK angle and the United States angle and other countries. And it's very instructive for this period because, one, it shows how they tackle high debts environments. And some of those are kind of unpleasant, things like capital controls and things like financial repression, that I think it's useful from, say, a Bitcoin perspective to understand these periods, to know how to navigate it, and some of the tools that they're probably going to bring in their tool chest.
I think that's a good point. I mean, looking at historical examples to see how we navigate through this. So you mentioned financial repression. And so when you get the debt to GDP level this high, you have to bring that back down. 130 has been kind of the kill zone. Most countries haven't come back from that, and we're flirting at the 124, 125 range right now. And so historically, how do they bring that back down? Financial repression is a way, and so they want to trap money into the financial system, close off the exits, don't allow you to exit, and then inflation rages high, so you keep bond yields low, inflation rages high, and they basically steal wealth, steal your purchasing power. And so that seems to be the playbook. The IMF wrote a paper on that in 2015, basically spelling that out. We've seen it played in Israel, other places as well. And so how do you protect yourself from that? Well, one way is to get out of that system they're trying to trap you in. And of course, Bitcoin is that escape route.
I don't have anything else to add. They covered it perfectly.
Cool. All right, we'll wrap it up. Now, so you talk about, Mark, you said, trapping capital in. The U.S. is the world reserve currency. What would that look like? You in somewhere like, say communist China, it's much easier to kind of trap people in. What does that look like in the U.S.? Like, how could they possibly block the exit ramps? And I'll give it a little more context. We talked about the last kind of U.S. defaults backstage, right? Briefly, where, okay, in 1933, it's not an implicit default, it's more of an explicit default on the gold promise, on the gold peg.
Right.
They confiscated the citizens' gold, then immediately revalued it higher, right? That's the last time bonds fell this much, or as much as they did in 2022. Well, there was a debt default. They devalued your gold, they confiscated it from you. The second time that bonds fell as much as they did in 2022 was 1969, 1970, right before Nixon defaulted on gold again, where they just said, we're not going to redeem your central bank IOUs for gold. So here we are in a fiat world, right? It's a debt-based economy. Bonds draw down, the risk-free asset draws down 25, 30% from its peak, and subsequently resets the valuation, reprices the valuation of every asset on the planet. There's no way to explicitly default, right? It's an implicit default. And so if they are to block the exit ramps, what does it look like in practice?
Yeah, it's a good question. And so to your point, we're not China. In China, it's very easy to do these things. They don't have open capital accounts, so they can just kind of close those exits. It's communist. We're the land of the free. So how do they do that? Well, how do they always get you in a cage? Well, it's for your safety. Of course. Fear, fear, fear. Hey, we need to do this for your safety. We can suspend Constitution for your safety. And so, unfortunately, the financial system is under duress. It's crumbling because of the actions they've taken. Of course, living well beyond their means, printing unlimited amounts of money. And so then there's a need for an exit ramp. Well, how do we do that in America, in the land of the free? Well, we do it for your safety. So, unfortunately, we need to protect the financial stability by you having an ability to get out of that crumbles, that weakens the financial stability. And so it'll be sold as Bitcoin being a threat to national security. You getting your money out would be a threat to national security. And you don't want to put other people at risk, do you? And so be a good citizen, accept what we do, go into the cage, keep your money inside the system so we can steal it away from you through inflation for your safety.
I think a really good instructive example we see is with some developing countries today that have currency issues. So an example is Nigeria for a while now has kind of severed crypto exchanges from their banking system. So it's actually really hard to make it illegal. There's a lot of enforcement points. It's easy to disregard that. But the lowest hanging fruit that countries can have is just make it either hard or entirely cut off from banks being able to go to these exchange points. And then more recently, we saw Argentina kind of make similar moves where they're dealing with 100% inflation, and so they turn to try to limiting the outflows that are going into things like stablecoins, Bitcoin, all these other assets. They want to stem the tide. And even before these types of actions, a lot of these countries have all sorts of restrictions on their citizens' abilities to get dollars. And again, sometimes it's on the individual level, but the easier place to do it is on the banking level, because even though some trickles in and out, it just kind of turns the fire hoses into garden hoses. It kind of slows down the leaks. And so it'd be kind of unprecedented in some ways to see it happen in developed countries, because part of what makes the United States global reserve currency is our open capital markets and all that. But when we go back in history, when you look at, for example, the World War I, World War II environments, last time you had very inflationary environments, last time you had major war, last time you had very high sovereign debt levels. The United Kingdom at the time was the global reserve currency, and they had all sorts of draconian capital controls, securities controls, lending restrictions. That's another thing we see in Turkey recently, is that when they try to keep interest rates low, but they have inflation high, so what do? Then they try to restrict types of lending that people can do, so that you can't, for example, borrow Turkish lira and plow it into gold or Bitcoin or dollars or something like that. They try to make that harder to do. And I think it's important not to be asleep at the wheel for some of those risks that could materialize in 3, 5, 10 years as we go through some of these kind of macro transitions that are currently happening and then probably still ahead of us.
I would just add a little bit to what Mark's saying. The security argument, I think, is a really key point for people to take away, and to also, when it happens in a couple years or 5 years or whatever the timeline is on that, and you see it, you're saying, I know exactly what's happening. But they're also going to sell it not just as a security point, they're also going to sell it as we're seeking order. We're doing this to make sure that there's not social unrest. We're not just doing QE, we're funneling money down to the lowest denominator to make sure that they're getting UBI checks. We got a small taste of this during COVID. They had to make sure that liquidity was flowing down into the lowest levels. If people knew how much of this debasement was happening, the printing that was being shoved into the QE and bond market since the 2008-2009 crisis, compared to the amount that was sent out for the UBI stimulus checks, people would think that the stimulus checks and everything that was mailed out was this huge amount. but relative to the amount that went out in QE, it's minuscule. But they have to start sending it down into the masses in order to have enough liquidity hit the street for people that literally have no disposable income. So they've got to seek order, they got to seek security, and that's going to be the shilling point that they're saying Bitcoin is bad, we're going to keep the system orderly, Bitcoin is the root cause, right? We know it's not, it's just software, it's running code, it doesn't care whether you use it or not. And the manipulation of the price of everything in the face of that is what's driving people to seek salvation over to Bitcoin. So I would just challenge people listening to this, audience, your friends, people watching this on YouTube, you have to take action. Bitcoin is going to be successful whether American politicians figure that out or not, right? We all know that. But as an American and a person who's served in the military, I can tell you, nothing would make me happier than to know that this country gets it. And the only way this country is going to get it is people sitting here, getting out there, educating friends on what this is all about. And when you hear security, when you hear they're doing it for order and stability and to stop social unrest, you're armed with the reality and the truth of what it is. And you can help inform your friends and families and politicians and all the people that have the influence to change this in the direction that we know what is best for this country in the long run.
Yeah. And I would add on to that, you know, what Lynn said, you don't want to be caught off guard. You don't want to be too late to move into this. And so one of the reasons why we understand macro, we study macro, is to understand the trend. Where are things going? You know, most of us aren't trying to figure out, should we trade Bitcoin today or tomorrow? What will the price be in 2 weeks? But we're trying to find the direction. And so one thing that you do as investors is you back test. And you go, in this type of environment, what happened? And so imagine, you know, she's saying that we're seeing this financial repression, capital controls in Turkey. We can go back to the 80s and see it in Israel, or she said earlier, like the 40s in the US. And so what happened during those times, and what would I have done if I was there? What would I do to prepare? So the Turkish lira has dropped 90% to the US dollar over the last 5 years. So if you were in Turkey 5 years ago, what would have been the move? Well, certainly not to hold Turkish lira. Right? Yep. And so now we're in that similar situation. And so what should you do? Well, probably not hold whatever currency that is, in this case, the US dollar. And so when you see these things happening, you see the trend, we understand from past experience what the right move would be, then we want to start preemptively doing that, not waiting until it's too late.
So let's game this out a little bit. A lot of people, there's been talk, and myself included, thought we were going to see somewhat of an economic downturn happen a little bit sooner. In the midst of the fastest rate hike cycle ever. But you have people like Stanley Druckenmiller saying, hey, like the biggest economic downturns I see throughout my career, who's studied every asset boom and bust cycle. He's, the greatest macro investor of all time, one of, compounded his fund at 30% annualized for about 2 or 3 decades. He's saying, this is we're just seeing the biggest everything bubble, sovereign debt bubble ever burst. And we're just, kind of still in the early innings of this. So if we look to, the next 12 months, 18 months, whatever the timeline may be, what is the policy response if and when this, soft landing isn't so soft, and we do see somewhat of a hard landing, or we do see employment rise, and we do see, say, the indices really sell off, right? Like, it seems like they've exhausted the monetary policy toolkit throughout the years. And yes, this rate hike cycle gives them some ammunition to cut rates and to provide some stimulus, but they used interest rate policy. They got rates to 0 for a decade. They used QE for a decade. They sent out UBI stimulus checks quasi in 2020 and 2021. It seems like that new bank term funding program, right, which allows banks to pledge these treasuries, these bonds, to the Fed at par, right? So here's 70 cents on the dollar, Preston, but you're going to give me $100 back at a super low interest rate, right? Like that seems like a quasi form of yield curve control in a way. But like, what is the policy response in this next downturn, right? Like what bullets do they have? What's in their war chest, and how to respond to, say, this, the next bust phase.
I would even go a step further and argue that it's yield curve control.
Yep.
Like there was a debate online whether that's QE or not. I would say it's yield curve control because they're saying, hey, the price can't go beyond like this limit. And if it does, like you can put it on deposit here. And the counter argument to that people are going to make was, well, and a year later they can come back and then it's going to be closer to where the price was and everything's good. And it's like, I'm stealing cookies out of the cookie jar, and I'm hoping that I can go back there and replace the cookie in the cookie jar without anybody knowing that I originally took the cookie, right? And that's the play. It's all about the price manipulation of credit, which then turns into the price manipulation of everything, because it's the cost of capital that they're playing with. And they're not just doing it with a little bit, they're doing it with literally the entire treasury market. So like, what's having issues right now? Why are the banks exploding? Like, we have more failures on banks per market cap this year than we had during the 2008-2009 crisis. And like, I think if you lined up 100 people on the street and you told them that, they'd be like, are you serious? Like, they don't even realize that that's happening. But that's how messed up the game has become after more than a decade of these policies. There's a fantastic book that I just recently read, The Lords of Easy Money, I think is the name of the title. And they talk about how the Fed has been chewing on these policies, and they knew that they weren't seeing the inflation show up in the prices of common goods that people are consuming that they're used to, the foods and things like that. But they did know that it was causing price inflation of assets. And they knew that there was going to be some type of reckoning to this at some point. And I think that, nobody likes to talk about the timeline because nobody really truly knows what the timeline is. But when you're seeing the debt ceiling, you're seeing how inverted the yield curve has been and continues to be, and the pace that they're moving at with the yield curve, it really feels like something's getting really close. I'm curious if Lynn, she might have a different take, and Mark might have a different take than that. But the manipulation just continues to enhance on the price of money itself, which means they're trying to manipulate everything else. And it's something that you just can't educate the public enough about.
I think the path we've seen for a while now, ever since, say, autumn of last year, is you've had these two opposing forces. So on one hand, you have the Federal Reserve still trying to tighten policy, whereas the Treasury was actually offsetting some of that. They were actually pushing liquidity back into the market using their Treasury cash accounts. It's kind of like how if you were not allowed to borrow debt and you lost your income, how would you keep paying your expenses? Well, you'd probably draw down your savings and keep paying your expenses until you basically ran out of savings. And so the Treasury has cash that they hold at the Fed that they have kind of like, in their kind of like liquidity buffer. And so for the past 6+ months, they've been pretty aggressively drawing down that cash balance and putting it back into the market because they couldn't issue more debt. And of course, their tax revenues don't cover it. And so you had Federal Reserve QT, and then you kind of had like Treasury QE. And the challenge, everyone's focused on the debt ceiling right now, and of course that's a hurdle they have to go through. Whereas I think the biggest question is what happens after the debt ceiling, because when the Treasury is no longer offsetting some of the Federal Reserve policies, I think you're at a risk of a liquidity challenge. And then beyond that, you either see the Federal Reserve probably have to change some of their policies, maybe end quantitative tightening or take other actions, or you need to see the Treasury make unusual actions. Like, for example, they can issue a ton of T-bills to keep funding their large deficits, but that's the most expensive part of the curve right now. So that'd be kind of like an unusual move by the Treasury compared to how they would normally want to finance in this type of situation. And I think that a lot of that probably materializes in the second half of this year, or maybe if they push it out, maybe early next year.
Yeah, I mean, to Lynn's point, we've been witnessing the Fed tightening, but then the Treasury's been injecting or easing at the same time. But to the point, this account, the TGA account, has been drawn down. There's not much there. And regardless of what happens with this debt ceiling debate, first of all, again, going back to history, we can see in 2011, even though a deal was reached at the last minute, we still saw the S&P 500 sell off by 17 points, so 17%. So it's still trouble. Either way, this is a bad long-term deal, breaking confidence in the system. But they have almost $700 billion of treasuries to issue after this. And if they're trying to do that at the same time that the Fed is tightening, that could be very difficult. But going back to what Dylan was saying, and even Preston was asking, but I think Dylan's question is, they've put this new 4-letter funding facility in place. It seems like their hands are tied, their back's against the wall. How many more of these can they do? And I've been asking myself that since 2008. That's really when I started getting really involved in this system because I got wiped out, I got hurt, I had to go figure this out. And I continue to think their back is against the wall, but they continue to pull another rabbit out of the hat. And so I think they're going to continue to surprise us. And the one thing that we know for certain, what's going to happen over the next 6, 8, 9 months, 12 months, we don't know, but money printing, it's certainty. And they're going to continue to come up with new funding programs. So I think they still have quite a few more tricks up their sleeves.
I just have one final point to kind of recap both of their just incredible description of all the moves that they're going to potentially make in the next 12 months. And as Bitcoiners and everybody in the audience, I think what you have to be prepared for is, since the 2008-2009 crisis, they've done this job where they've created stability in the market through these short-term, these decisions where they're really focusing on the short term at the expense of the long term. And as somebody who's holding Bitcoin and seen all these gyrations over the last year, and you've seen these cycles that play out with this really nice looking 4-year kind of price curve, I would just tell you, you need to be prepared for pretty much anything that's coming, because there's decisions being made by like 5 people sitting in a room, and if like 3 of them just don't show up and like push a certain lever, right, then the impairment that can churn into the market, or the amount of monetary units that can flood the market, can happen. Well, I mean, we saw it with COVID, how quickly something like that can happen. And I think we're just ramping things up, and the volatility that's to come is going to be extremely profound. And people that are long-term holders that truly believe in Bitcoin and really understand it just have to be ready for that volatility, because what it's representing is the fiat system itself.
I mean, I'm not the moderator, but if I can ask Preston a question about that. Because, to your point, and I would agree, massive volatility ahead, be prepared for any situation. But is that more of a short-term outlook? If we're looking at 3 years, 5 years, 8 years, does that volatility smooth out?
I don't know. I think in the next...
And not, I mean, maybe it stays volatile, but are we moving up and to the right over the long-term period? I mean, I think we both agree that...
Yeah.
Right?
Yeah. We're moving up and to the right.
So if we zoom out and look over longer...
It's hard to say, because I just don't know how... I'm expecting a lot of impairment, like in the next 3 years. I don't know if Lynn would agree with that, but I think you're going to have like this really substantial impairment event where they're going to have to try to plug that with new monetary units. And the challenge for them is, like, they just don't know how long a lot of that's going to take hold, depending on which path they go, which is the UBI. They got 2 paths, UBI and QE, right? It's really the 2 paths. And they hit the market, that liquidity comes into the market at different timing, and at all of it, right? If it starts showing up in the inflation gauge, like, that's going to be devastating to the credit markets, which everybody knows are hundreds of trillions of dollars in size for all G7 credit markets. So, like, there's so much, it's levered so much, and their ability to pull these dials into those 2, into QE or UBI, is what's going to make it so difficult to kind of understand whether we're going to have rip-roaring inflation or these deflationary busts. So question over to Lynn. I'm curious her opinion on that.
So I think the biggest challenge is that people often think of like policymakers as one monolith, but you almost have like different factions that are operating. And I think one of the big challenges is that a lot of the inflation we've seen is from large monetized fiscal deficits. Right? So that was true in the 1940s, and it's true now, whereas in the 70s, most of the inflation was coming from actually bank lending. And the Federal Reserve only has kind of a pretty small set of tools to deal with that. They can raise interest rates, they can do other things to kind of restrict how much bank lending is happening. And so you see, for example, when Jerome Powell talks about his inflation-fighting efforts, what he's mainly focuses on trying to get banks to make fewer loans. He's trying to restrict the availability of credit, and the challenge is that wasn't the heart of why inflation happened. That wasn't the source of new money creation this cycle, and it wasn't the source of what's happening, but it's the only lever that he really has control over. So that's actually something you see in those periods of financial repression, or to more extreme extents, capital controls, but even just financial repression. Because you have the public sector flooding the market with what is currently $2 trillion annualized deficits, pretty much, because you don't have asset prices going up and you still have those large expenditures. The problem is that as that goes into the market, the only thing that the Federal Reserve knows how to do is basically then try to control the private sector, the banking credit sector, to shrink a little bit, and so you have that classic crowding out effect. And so I actually think that some of the stimulus we might see in the future, like let's say when they eventually run into a liquidity problem, they have to kind of inject liquidity back into the market, I don't think we'll see the types of like direct stuff we saw last time. I think there'll be a somewhat more like bifurcated environment where they're trying to, on one hand, prevent money growth too much from, say, the banking system, while they still have large money growth in the public sector. And that's where you can get your risk of more of these capital controls coming into place. They could say, okay, we have national security issues, so banks are now highly restricted from dealing with certain industries or sending money in certain directions. And that's always easier for them to manage than on the individual level.
Yeah.
And what always comes with capital controls and a way to control inflation is price fixing as well. And so watch out for that.
Horrible idea. All right, so we got a few more minutes. We'll try to fit this in. One of the popular things that was kind of maybe debunked, or one of the popular narratives that turned out to not be true through much of 2022 and even 2023, was like Bitcoin as this like uncorrelated asset, right? And through most of 2022, right, the correlation was almost 1 with legacy assets, with risk assets. One of the things that I argue is that if we're expecting Bitcoin to monetize on the balance sheets of everyone on the planet, then a correlation with risk assets, a correlation with equities, which are everybody in the U.S. that has any sort of 401k pension, they're passively investing into equities the same way that someone might passively DCA into Bitcoin. And so, is a correlation to risk assets for Bitcoin a bad thing, right? I personally don't think it is at all, and I think it's actually logical if you consider, like Preston said, like the contraction of credit and the expansion of credit. That liquidity tide is what's driving all of these, every asset on the planet. And so if Bitcoin is to nestle itself on that balance, on that asset side of the balance sheet, where everyone has assets and liabilities, is a correlation a bad thing? Is it a good thing? Like, how do we think of that?
I think it's fine because, for example, if you look at, say, Apple stock and IBM stock over, say, a 10, 20-year period, probably on most days, they probably both went up or both went down. Obviously there's some days where one goes up, one goes down, but more often than not, you'd have them moving in a similar direction. And of course, the main difference is that Apple generally goes up a little bit more and down a little bit less, and it grinds that out over a longer period of time because at least during that period, it was a far superior asset. And I think it's one of those things where you worry less about the direct correlation and focus primarily on, do you own the most superior assets or not?
Is there a second best?
There's no second best.
On that note, we'll wrap it up. All right.
Oh, we're out this way.
There you go.
Welcome back. I'm Pete Rizzo, editor of Bitcoin Magazine. We're here at the Bitcoin Magazine live desk presented by Marathon, joined once again by our special guests, Ran Neuner and Aaron and Austin, co-hosts of Altcoin Daily. Before we go back to the main stage, we're going to give a quick plug for the new Bitcoin Magazine on newsstands now at bitcoinmagazine.com/store. Look, the Julian Assange cause is important. He's a journalist of the highest order. He deserves your support. You can read about him more in the new magazine.